for the current financial year 2021. It was a very changing, very thought-provoking and a changing budget for all of us. And first time we got a concept of two different tax regimes to be handled by us as an individual. So we are organizing this special session for you all, where we'll be exclusively discussing on taxation, specifically related to the salaried person, the tax benefits, the tax calculations, and the main concern currently of a salaried class is what regime should I select for the declaration. That is the basic topic of the session. Mahendra Shetty is with me. He is my co-host. He'll be conducting the session on the total tax angle. Let me tell you the agenda. 15 to 20 minutes, we'll go through the tax rules, the changes that has happened, the regimes that have been uploaded for us. And in the next 15 to 20 minutes, you can put your questions in the chat box as we move into the session. And we can handle your question and queries, whatever you want to. Thank you all for coming here. I'm Sunil Srivastav, a certified financial planner. And with me, it's Mahendra Shetty. I'll just hand it over to Mr. Mahendra. Mahendra, you.
Thank you, sir. So I would like to thank you all for giving us this opportunity to connect with you and through this platform, making you understand and also we learning more about income tax. So without wasting much time, we will start with the session. I'll just put it on a chat box if I'm, if you're able to hear me, if I'm audible.
Yes, Mahendra, fine, it's fine. Go on.
Okay. Are you able to see the screen, people?
Yes.
Okay. So thank you. So before we start, I would like to say, whatever questions you have, I would request you all to please put it on chat box. At the end of the session, we will take up with all your questions. Okay. So thank you so much for joining us. Let's start. So we at Dream Investment, we are more involved in learning, coaching, and mentoring part. Okay. And the same thing is what we are looking forward to share with our clients. So thanks for joining us. So the concept came with chai ke saath tax ki baat. And how many, I have put up some questions. We'll just go through that and see if you have already planned according to that. First is, what are the current changes in the new tax rules? So have you gone through that new tax rules? Do not worry, we will be sharing all these things, but some of the points to be thought and to note it. Second is, do you know which tax regime suits you? Okay. Next is, what are the exemptions allowed under new tax regime and as well as the previous one? And have you selected the tax regime for your declaration? So I'm sure most of you must done your declaration. So have you selected the right one or which one you should have selected? We will see that also. Now, today's agenda, these are the basic things that we will share in today's session. One is we will be sharing about income tax slabs, the percentage of as per the slabs also, income tax exemptions. We have done one sample calculation so that you could understand the income tax calculation in very easy manner. This will help you to calculate your income tax at your end also. If time permits, we can do a demo calculation. However, it is already covered in the sample calculation, but we can do. Now, most important part is, I'm sure you are here to understand about income tax, which we will definitely share with you. But beyond income tax, so when you save your income tax, what is it that can happen, that magic can happen with the amount of tax you have saved? So we will see and we will learn how the tax which you have saved through proper income tax planning can help you to create 1 crore for you. Also, there are different things, financial goals that you have in your life. How this tax which you have saved can help you to achieve your financial goals by proper tax planning. For example, buy a car, repay your housing loan, help your retirement, your child education, child marriage, and at the end we will go with the question and answer session. So while discussing this session, you can keep few things ready with you if you want to calculate your tax at your end. So few things to be noted is CTC, basic clearance allowance, your HRA, and your investments. Let's start. First, we'll start with the income slab tax. So tax regime financial year 2021. So we are focusing on this current financial year. As per the old tax regime, if you are a male or a female, the tax which is exempted is 2,50,000. If you are a senior citizen, whether you are male or a female, it doesn't matter. It will be 3 lakh rupees. And if you are a very senior citizen above 80 years, then it will be 5 lakhs. What does this mean? This means if your salary is 2,50,000, you need not pay any tax to the government. It is exempted up to this particular limit. So there is no tax on this. Okay. As per the new tax regime, again, it has been made very simple, irrespective of your gender, irrespective of your age. As per the new tax regime, it is 2,50,000 what is government has proposed. Okay, so up to this income, you don't have to pay any income tax. Then when does your income tax starts is what we are going to look now. I hope this is clear. After every slide, I will take a pause so that you can put your questions and then focus on the next slide so that we don't miss out anything. So the basic takeover from here, we'll see. So 0 to 2 lakh, as per the old regime, 0 to 2,50,000, there is no income. It's a nil income tax that you have to pay. If your income is up to 5 lakh, or if your income after all deduction and investment is coming to 5 lakh or up to 5 lakh, then a TDS of 5% will be deducted from your 2,50,000 to 5 lakh, which is 2,50,000. 5% comes to 12,500. This can be refunded when you file your income tax return. Okay. So in simple words, I'll share it. Up to 2.5 lakh, there is no income tax for you. Okay. It will be there, no income tax till 5 lakh. However, if there is any TDS which is deducted, you can take a refund. So the takeaway from this particular slide is 2.5 lakh is the tax exemption, 2.5 to 5 lakh is 5%. However, you can take a refund. And as per new regime, 2.5 lakh is the standard exemptions given. I hope this is easy. Any questions you can definitely put up in the chat box. We'll take it at the end. Next, let's understand the tax which is proposed in this current year. So as per old regime, we will understand up to 2.5 lakh, it is nil. 2.5 lakh to 5 lakh, you'll have to pay 5%. 5 lakhs to 10 lakhs, it will be 20%. And 10 lakh and above, it is going to be 30%. Okay. So in the previous slide, I said to you, if your total income or after all declaration, if your income comes to 5 lakh, then you can take a refund under section 87. However, if your income goes above, you'll have to pay 12,500, that is 5% income tax as per your tax slab. So these are the old tax slab. We will also see what are the exemptions allowed by the government under old tax regime. First is your professional tax. So from your total income, you can deduct your professional tax. There is a standard deduction which is given of 50,000 by the government. HRA depends upon your, it has calculations, 3 options. So as per that, it will be eligible. Home loan interest up to 2 lakh rupees. You can also avail it under section 80C up to 1,50,000. You can show as a declaration. Under 80D section, there is an exemption of 25,000 rupees if you take an health insurance policy for yourself, for your kids, and for your spouse. In addition to that, if you are going to take an health insurance policy for your parents, and if they are below 60 years, you will get additional benefits of 25,000 rupees under section 80D. So the total amount that you can claim under section 80D is 25,000 for yourself and 25,000 for your parents if they are below 60. If your parents are above 60, in that case, it will be 50,000. So now you can claim higher tax benefit under section 80D, 25,000 for you, your kids and your spouse, and 50,000 for your parents if they are above 60. So that will make 75,000. So the maximum limit under 80D will be either for yourself, 25,000, for your parents, 25 plus 25, 50,000. If they are senior, then 25 plus 50, 75,000. The next slab which is there is under NPS, National Pension Scheme. So under this, you can also claim additional 50,000 rupees for your tax deduction. There are some companies through which you can do additional tax benefit. You can take it. That will be 10% on your basic. I hope this is clear. If any doubt, you can definitely put it in your question. Now let's look at the new tax slab regime, which has been introduced from this year 2020. Under new tax regime, these are the tax slabs which are there. So up to 2.5 lakh, it is nil, as I said earlier. 2.5 to 5 lakhs, it is 5%. So if you look at the old tax regime and the new tax regime, up to 2.5 to 5 lakh, in both the scenarios, it is 5%. Now, actual tax calculation happens when you go ahead or move ahead, that is beyond 5 lakh of your income. So 5 lakh to 7.5 lakh, it will be 10%. 7.5 lakhs to 10 lakhs, it will be 15%. 10 lakh to 12.5 lakh, 20%. 12 lakh to 15 lakh, it will be 25%. And anything above 15 lakh, okay, I typo error is there. Anything above 15 lakh, it will be 30%. Not 30 lakhs, 15 lakhs, it will be 30%. Okay. Now, what are the tax benefits available under this? One is under this only professional tax what is available. That is one. Okay. However, if you have NPS under your employer, then 10% of NPS of basic can be considered under new regime. So these are the options for exemptions available under new regime and old regime. I hope this is okay with you, clear with you. We'll move to the next slide. However, if there are any questions, please put in your chat box so that you have a clarity at the end. Now I'm moving to the next slide, which will show the exact calculation of your tax. So let's look at an example of old tax regime. Let's assume your gross income is 15 lakh rupees. And under that, you have taken all the exemptions or deductions. So let's assume professional tax 2,500, standard deduction 50,000, housing interest 2 lakh, ATC you have taken fully 1,50,000, ATD 25,000, and national pension scheme NPS 50,000. So total deductions for you is 4,77,500. Now, you're not paying income tax on your gross income 15 lakhs. You will have to deduct all these exemptions. So from 15 lakh, if you deduct 4,77,500, your net taxable income is 10,22,500. I hope this is clear. Now, on this, we will be calculating the tax based on the tax slab. That is, from this 10,22,500, from 0 to 2.5 lakh, there is no tax, so it is 0. 2.5 lakh to 5 lakh, it will be 5%, that is 12,500. 5 lakh to 10 lakh, the difference is 5 lakh, so 20% on 5 lakh will be 1 lakh, and the above 10 lakh, it is 22,500. So 30% of 22,500 comes to 6,740. Now, the total tax that we have calculated comes to 1,19,250. However, there is also an additional 4% education cess which is government will calculate on this. So which comes to 4,770, 4% of 1,19,250. And your total tax which you are paying is 1,24,020 rupees. That is your total tax. I hope this has helped you to understand how your tax has been calculated from your gross income, then your exemptions. From that exemption, the balance is your net taxable amount. From that net taxable amount, as per the tax slab, you have to calculate. That is, you'll have to see the total tax, education, you have to calculate education cess, and the final amount is your total tax that will be paid to the government. Now let's look at with the same scenario under new tax regime. Under new tax regime, we will take same example of 15 lakh rupee gross income. So from 15 lakh rupee gross income, the exemption which is available is 2,500. So if we deduct 2,500 from 15 lakh, the net taxable income comes to 14,97,500. Now, from this net taxable income, as per the tax slabs, we will have to do the calculations. So up to 2.5, it is 0 because there is no tax. Second is 2.5 to 5 lakhs, it is 5%, so 12,500. Next is 5 lakh to 7.5 lakh, it is 10%, which is calculated. So the amount comes to 2,50,000. So 10% of 2,50,000 is 25,000. Next is 15%, which comes to next slab is 37,500. 10 lakh to 12 lakh 50,000. There is a 20% tax slab which comes to 50,000, and the next slab will be 12 lakh 50,000 to 15 lakhs to 25%, which comes to 62,500. Now, on this, the total tax which we have added is comes to 1,87,500. On this, we have calculated 4% education cess, which becomes 7,500. Total tax paid is 1,95,000. I hope this is clear. I'll repeat once again. Gross income 15 lakh, exemptions 2,500, net taxable income 14,97,500. On that, total tax to 4% tax on that, education tax 7,500. So 7,500 plus 1,87,500, total taxable income is 1,95,000. That is the total tax you will be paying. One. I hope I'm audible.
Mahendra, if you can put off your video for some time because there is a range issue.
You want me to?
Put off your video. There is a range issue.
Okay. But will that show the slide? I don't think so.
It's showing the slides, no issues.
Okay, okay. I hope you are able to hear me.
Yes, yes, go ahead.
Yeah, thank you. So we have seen how or what is the calculation as per old tax regime and what is the calculation as per new tax regime. Okay. Now let's look at a scenario wherein the third scenario. Okay. However, before that, if you look at the difference between old tax regime and new tax regime, I would be more happy if you could calculate at your end what is the difference, and you can probably put it up in the chat box so that I can tell you what are we going to do with this. 1,95,000 minus 1,24,020. Around 70,980 rupees is what is the difference between these two. Okay. Now, before we proceed, let's understand one more scenario. We will be calculating the tax basis old tax regime, but without any exemption, so that this will give you an idea what is the old tax regime, what is the new tax regime, and what is the third option which is available, because it may be applicable to some of the people. Okay, so this is our calculation which we have done basis old tax regime, and we have not taken any deductions apart from professional tax and standard deduction because it is by default there. So in this scenario, you have seen same 15 lakh gross income, total exemption we have taken is 52,000, net taxable income is 14,47,500, net tax comes to 2,46,750, and education tax 9,870 rupees. So total tax under old tax regime, if you do not opt for any of the standard deduction, it comes to 2,56,620. Okay, now this is a scenario wherein it is a very important decision for you to make whether you should go for which tax regime suits you, because in this case, what will happen today, you may not opt for a certain deduction, a certain investment option, ATC, ATD, or a lot of options which are available for you, and you might go for a new tax regime. However, it is said that if you get into the new tax regime, you cannot come back to the old tax regime. But it is very important to take a wise decision, because today you might be single, tomorrow you'll get married, you will go for a housing loan and everything. That time, if you want to opt for this, then you might lose on certain options which are already there under old tax regime, because old tax regime gives you if you see the calculation, see the amount that you have to pay as per old tax regime, new tax regime, and old tax regime without any exemptions. So that's the reason I would suggest to work out on your financial or tax planning, you need to connect with your financial planner. They will help you, they will guide you to take a wise decision. Do connect, because what the situation is today, things will change tomorrow for you. So rather than taking hasty decision, I would say for right decision, connect with your financial planner. Any questions, I would request you to please put up in a chat box so that we can take it up at the end of the session. Next, I had asked you to do the calculation from difference of 1,24,000 and 1,95,000. So which comes to around 70,980. Okay. So I'm not taking a huge amount. Now, what will you do? Let's assume if you have saved your tax as per old regime, or any while using the tax exemptions. But after doing all this, when you save your tax, what do you do? That's a very important question, and it's something that we need to focus on. And that's the reason we thought we will connect with you, so that we can show and tell you what is possible out of it. So we just did, and we'll go to the next slide and we'll understand. We just did one calculation. Okay, let's assume if you have taken a housing loan, and we have taken an example wherein you have saved 50,000 rupees from your tax. Now what is it possible out of it? So let's assume you have taken a housing loan of 50 lakh rupees for a duration of 20 years, and the interest rate example we have taken at 8%. Do you know that at the end of 20 years you end up paying 50 lakh 37,281 of interest on your housing loan? That makes total payment towards your house 50 plus 50 around 1 crore 37 lakhs 281. 1 crore 37,281 rupees. Now let's assume if you the tax which you have saved, for example 50,000 if you have saved, and if you do a proper planning for that by sitting with your financial planner, what is the magic it can create for you? Let's look at it. Your total tenure term from 20 years will come down to 16 years. Imagine how it will be when you are from EMI free for last 4 years during your retirement time, and you don't have any burden or tension to take up, right? So the best relief is to bring down your tenure from 20 years to 16 years. Second, very, very important part, it's your hard-earned money that you are putting in for your EMIs. Your total interest will be paid 38 lakhs 80,000. So you can imagine earlier, without any tax planning, you are paying 50 lakh 37,281. But now, after proper planning with your financial planner, it has brought down to 38 lakhs 80,000. So you can imagine the difference, and that is your hard-earned money. Okay, so that's the reason I would suggest connect with your financial planner. It will help you to plan your tax properly, and there are a lot of things. Let's look at another thing, what another option or financial goal it can help you with. Next, child education. If you do your proper planning with your financial planner, this money of 50,000 which you have saved can help you to create a investment or child education money for your future, or for your child's future, of around 28 lakh rupees. So when your child is 18 years, almost when the child is done with 12th standard, for higher education you need very big amount, and the inflation for education is high. So this amount which you have saved through tax can help you to create at least 28 lakhs if you do a proper planning. Next, it can help you. So let's assume let's assume if your current age is 30 years, and if you're planning to retire at the age of 60, this 50,000 can help you to create 1 crore 10 lakhs by the time you retire. If you're 30 today, by 60, this is 1 crore 60 lakhs is what you 1 crore 10 lakhs is what you can get if you do proper planning. In 25 years, so for example, if you're 35 years old now, and if you plan to retire for 60, so in next 25 years, it can create 64 lakhs. So that is the reason, do not take your tax as, just a kind of activity. It's a very, very component part of your life. It's your hard-earned money. So connect with your financial planner, and the financial planner will definitely guide you in the right path. So or the last is we don't know how or what to do. So what we end up doing is we spend that money and we don't know what was possible with this money if it was put in a right direction with your financial planner. Okay. Okay, so any questions on this slide, I would request you to please put up on the chat box so that we can take this at the end of the session. Now we are almost on the last slide of our session. We at Dream Invest, what we believe is coaching, educating, mentoring our clients. And that's the reason we thought of this last slide to put up so that it can help you to take away something from this slide. Okay. Most of the time we are so focused. So I'll tell you what is internal and external factors. So we have seen the tax slabs, in the old tax regime and as per new tax regime. I want to ask you one small question. Let's assume if your salary is 15 lakh rupee today, can you tell the government, I will pay you only 5% of my tax. I will not pay you anything else. Is that possible? Practically not, because you cannot make any changes in the tax slab because that is something designed by the government. So what I'm trying to tell you, tax slab, which is designed by the government, is an external factor. What you can do is you can plan your tax planning. That is something internal. So in this slide, we are trying to focus on internal and external factors so that you understand what are your internal factors and what are your external factors. External factors are not in your control. Internal factors are in your control. So I'll take one more minute of this and try to explain you. So basically what I'm talking about information house. In economy, you will get a lot of information. You can find a lot of information on Google, different websites, on the company sites and everything for your information. Okay. Economy, if you look at inflation is the GDP, all these things, so which are not in your control, right? For example, a particular company, the mission, vision, or how the company should perform, how the company is not performing, it is not in your control. There might be a particular company, so the stakeholders, the management is controlling it. You cannot do anything. Are you getting in the company which you are investing? Second, product. So every company will have different products. You cannot go and tell the company, I'm going to invest 5 crore with you. You design me a special product. That is not in your control. In your control, what is there is to invest in the best product that will give you good returns based on your financial goals. Okay. So this is something external factors. Then wealth utilizations. Basically, wealth utilization, you can say, after your investment, when the money grows, you will be using that money, and after how that money can be transferred to your next generation is what. Internal factors is something very important. You need to focus on your outgo management, liability, personal, family goal planning is very important, risk management, asset allocation. So these are internal factors. So I would suggest you all to please connect with your financial planners. They will definitely help you understand what are the internal factors, what are the external factors, and it will be a very good and a simple way to create your financial goals with tax planning. So I'm done with the session. If there are any questions, I would now we can take those up.
Yeah, Mahendra, just put off the PDF.
This one?
You put off the PPT and put on your videos.
Yes, sir.
We have some questions here. Yeah. Thank you, Mahendra. It was very much informative, and it will really help us to take a call at the very beginning of the financial year. Okay, what exactly is our requirement on the taxation? Because this is a year where we are changing. This is the year where we are changing. So this is at the very beginning of the year, we can take a decision to which tax slabs we can work on.
Definitely. Yeah. So go ahead. Yeah. Before we move on to question and answer session, I would like to share with you the person sitting with me is Mr. Sunish Srivastav. He is a financial expert in this industry for the last more than 2 decades. He's a certified financial planner, and he's a mentor through which we are being mentored, guided, and learning. So all the questions and this thing will be answered through Sunish sir, and partly by me also.
Yeah, thank you. See, the fundamental question is which tax regime should I be selecting? And as you rightly said, as we are on the verge of shifting from regime A to regime 2, and this is the transition phase. In this transition phase, each individual taxpayer will have to sit down, work exactly what he is thinking. Each taxpayer has to sit down. Each taxpayer will have to sit down and work on exactly what his requirements are in near future. Because if you see under regime, old regime, if you are taking all the exemptions, then it makes very good sense because your tax liability is reduced a lot. As against if you move to the new regime, if you're not taking any exemptions, then it makes sense to be in the new regime. But as a youngster or as a person who has started working freshly, he might not have liabilities today or investments today, but in due course, he will go to those investments. So under that case, each individual will have to sit down and take a proper decision on what tax regime he should select. Okay, there are some questions in the chat box and let me put them up first. First is from Mr. Dheeraj. Can you say if you are having a housing loan, old one should go for the one should go for the old tax regime? Yes, Dheeraj, it makes sense to be with the old tax regime if you're having a housing loan or if you're planning to go for a housing loan in near future. Because in the if you look into the exemptions that we are allowed under chapter 6, 80D, 80C, certain exemptions we are by default doing them. For example, professional tax, standard deduction of 50,000, or normally your 1.5 lakhs under 80C, you are having your PF, your housing principal there. So that might take that 150A contribution. And the section 24(2) interest, all put together, help you to reduce your tax liabilities largely as compared to the new regime. So if you're taking all benefits, or if you're going to in near future going to take all benefits, it makes sense to be with the old tax regime. Okay, Mahendra, this is for you. Yes, can you change the regime once we have selected?
Okay, so am I audible? Can you hear me?
Yeah. Yes, sir. Yes.
Okay. So currently they said there is there is no option to change your tax regime to from if you changed from new one, you cannot go back to old one. That is what currently they said. So there is no option to change.
Yes. Okay, one more here under section 80D. If one parent is a senior citizen and the other is not, then how it will be calculated? Well, this is a very specific question. Currently, we normally take the age of the highest parent because there are no proofs to be submitted when you are taking 80D declarations. Normally, we take the benefit of the highest parent, highest age of the parent, and you can claim the benefit of 50,000 where the parent's age is above 60. Any questions there? Okay. Any questions further if you want to ask? Because this is something that these were the 3-4 questions. If you want to unmute, I'll just unmute you people, so you can ask direct questions also. Okay, you can unmute yourself wherever you want to ask the question.
Hello, sir. This is Balaji here.
Yeah, Balaji, sir.
Yeah, one question is right now this 80C will have 1.5 lakhs and the loan against housing loan will be 2 lakhs. Both I can show if I am taking a home loan as well as I am investing on tax saving instruments. Is it correct, sir?
Yes, I'll just brief on that. See, 80C in your housing loan, there are two components, the interest component and the principal component. The interest component comes under 24(2), where you can claim the 2 lakh rupees interest benefit. And the principal component comes under 80C for that 1,50,000 rupees. So once you get the bifurcation of your income tax of your interest certificate, the principal component will go to 80C and the interest component will go to 24(2), and both benefits can be claimed separately.
Okay. And one more question. In 2019 and 20, we did not submit the tax. That will be done by this year, right?
Yes.
2019-20. By July 31st is the last day, is it?
No, by July 31st, if you have not done any investments in the last year, and if you still want to take that benefit of doing investment in the last financial year, The date is up to 31st of July. So any investment done in this current year, you can adjust it for your 80C or 80D benefit for the last year, or even NPS benefit for the last year. And the returns can be filed till November end. So you can claim the exemptions in the November at the time when you're filing the returns.
So filing returns will be November. Deadline is
Yes.
November. From
November.
July.
Yeah, deadline is November. Now
Next
you cannot.
year,
Now you cannot give those investments to your employer because they have already finished with the 16 A's. So you will
Yes,
have
sir.
to claim it in your returns only.
Okay, sir. Thank you.
Thank you. Okay, one more question. Are the interest on earlier saving and on no fresh investment is considered as income? Are the interest on earlier saving and no? Yes, I couldn't get it, sir. Sagar said if you can elaborate on this, what exactly you want? You can unmute yourself. Hello. Sagar sir, you had asked a question. Are the interest on earlier saving and no new fresh investment is considered as income? I couldn't get it.
I mean, there is no new investment, just we have bank savings earlier. Can we, is it considered as new income?
Yes, the interest that you get in the every year is taken as the income for that year. So the interest earned by you on your own old bank deposits, the interest earned in this financial year will be considered as income for the current financial year.
Okay, thank you.
Yeah, fine. Okay. Please give more insight on NPS, and I have heard there are two NPS options, self of INR 50K and another one. Yes, yeah. See, NPS, basically, there are two options under where you can do your individual investments under NPS, that is section 80CCDB1 up to 50,000 rupees, and above your 1,50,000 under 80C, this is an additional investment that can be claimed for. The other benefit is under section 80CCD1. It is basically with your employer, where your employer can give you an NPS facility and maximum 10% of your basic can be taken as exemption, as we take PPF as an exemption or PF as an exemption 10%. Same way, the contribution by employer up to 10% of your basic can be taken exemption under 80CC D1. D1 and B are two different sections allowed. Okay. There is one more question. So the individual who is below income, there is 20 lakhs, there is not much thinking allowed. It's not that way, Dheeraj, because if you see any person above 15 lakhs also will have the same tax benefits, because the tax benefits are up to 15 lakhs. After 15 lakhs, it is all 30%. So the major shuffle or adjustments will be in those 15 lakhs only. So maybe if I'm not, let us say a person is about age 45 or 50 now, and he doesn't have any housing loans. He doesn't have any 80C, 80D investments to be done. He needs money for his child education now for the current year or next 2-3 years. He will prefer, instead of doing that 1,50,000 rupees investment, or he doesn't have that housing interest, so that 2 lakh rupees exemption is not getting. So this person can prefer an old tax regime, the new tax regime, and he will save more on tax in the new tax regime. And also, when he is not doing that 1,50,000 or 50,000 NPS investment, that 2 lakh rupees additional is available for him as cash in hand for his child education and other things. So person to person, in which age he is and what are his next 5-6 years priorities, that will decide what taxation he should be into. Okay, there is one more, return on PPF. How can we get more return by investing in tax saving instruments? Return on PPF and other tax saving instruments is limited. Okay. Now this is something that comes to my topic, to the topic of my heart. What we say, the investment planning process. Let us try to understand. I'll take you something away from the tax calculation part. See, any investment, the return on any investment can be divided into two categories. One is the capital market investment, or what we say the sentimental investment, where you have real estate, gold, equities, and other things. And the other one is the sensible investments, when you have bank deposits, LIC, PPF, the safe type of investments. There is a relationship between inflation and this returns. Normally, inflation to safe market returns are plus 2%. And inflation to capital market return is roughly 90% plus to inflation. but again with a 30-35% risk on time. So for example, if I'm expecting a 10% return on my mutual fund with a 6% inflation or 5% inflation, that means during the period of 20 years, there are 6-7 years where my money can be negative. So as an investor, I need to balance my asset allocation between my safe investment and my capital market investment. And this concept is called asset allocation. And that is priority. That is the priority or the input which your advisor should help you to work on what exactly you need. The safe investments in India will always be +2 to your inflation. For example, your bank FD, LIC, PPF, their investment patterns are same. So there won't be any drastic changes in the safe market returns in India. They will vary might by for example, a difference between LIC and PPF is around 0.5%. This can be a variation because of the insurance loadings and other things. But ऐसा नहीं हो सकता है कि आपका बैंक एफडी इन्फ्लेशन 6% है और बैंक एफडी 10% रिटर्न देगा. It is not possible. We need to understand technically this is how the economy moves. So instead of going into safe or non-safe, my suggestion is you balance your portfolios into your capital market and debt market returns properly. No, there's one question. If I select the tax regime for FY 2021, can I change it back to the new one in the next year? No. Currently, see, basically, the budget is not yet been passed. It is not yet been cleared yet. But what Sitaraman madam had told at the time of the budget, that there is no possibility of shifting from the old regime to new regime, from the new regime to old regime. But let us see what happens at the end of the once the budget is passed. But currently, you are not allowed to shift from new to old again. Okay. Can you explain where STCG and LTCG will be applicable on various investments and it will be taken into account? Okay. We have normally two different types of taxations. One is called income tax. So all your incomes and safe investment returns are called as incomes. So for your bank FD interest, your mutual fund interest, or your postal investment interest, this is called as income. They are taxed under the slab called as income tax. The other investment category that we have is called capital gains account or capital investments, where your equities, mutual funds, your real estate, your gold, that comes under the capital investment category. Under capital investment category, the tax is called capital gains tax. Under capital gains tax, there are other different bifurcations. For real estate, the tax slabs and the durations are different. For equity, the tax slabs and durations are different. In equity specifically, it is divided into short-term capital gains and long-term capital gains. So STCG is short-term capital gains and LTCG is long-term capital gains. In equity, if your investment is held for less than 1 year, it is called as short-term capital gains. And if you hold your investment more than 1 year, it is called as long-term capital gains. That is basically related to equity. 1 year, you should be holding your investment for 1 year. That means, let us say if your SIP is going on today in, let us say, any equity mutual fund, and today is July, your investment of July installment has to be held for 1 year. So your withdrawal can only be in August next year. Your August investment will be withdrawn only in September next year. That is, it's not that way that I put 12 months and at the 13th month I can withdraw. Every installment has to be held for 1 year. Then only you can go to long-term capital gain. This applies for equities, that is equity mutual funds, as well as pure or direct equities. Under real estate, the short-term capital gains is less than 2 years. So if you have purchased the property and if you are going to sell it less than 2 years, the profit will qualify for short-term capital gains. And if you hold it for more than 2 years, it will qualify for long-term capital gains. Okay.
Sir, final one question, sir. Balaji again here.
Yeah.
Just want to check with you right now. In Form 16 or in TDS, the amount that come through earnings are calculated, and my tax can be calculated, and I need to pay for it. For example, in my SB account, there are certain credit which will happen, which can be of any reason. One is I can get a regular rent income from my own property, or somebody transferring my funds by I'm giving some financial planning to them, which are not recorded anywhere. Okay, for example, I'm giving stock tips to somebody. They are paying some money for them to me based on the tips I'm giving. So these are other income. How are they will be affecting or calculated in the income tax if it comes into effect, sir?
See, basically, any income that is coming to your bank account has to be accounted for. Any income that is coming to your bank account has to be accounted for, because you cannot hide that income. So that is the first reason case. Now, how it can be accounted? For example, if you are giving any tips and other things, you can create a business income from that, and you can go under the heads of income from business, and then only it can be, because it's your consultancy or service that you're offering, so it will form under the head of income from business. Any interest income, if you are getting, or any will form income from other sources. The rental income will come from income from house property. So there are different heads already defined in the Income Tax Act: income from salary, income from business, income from house property, income from capital gains, and income from other sources. So depending upon the source of your income, you can choose that head. When now in your case, when you are giving consultancy, that will be that you can accommodate under income from business professional consultancy charges. So you can be taking you have to maintain a proper books of accounts for that. You can show certain expenses on that, and the balance amount will be added to your gross income along with your salary income, and then taxed accordingly to your salary slabs.
Okay, actually, I'm a salaried person. I get various other sources of income, but however, those are in an unorganized sector. I mean, unorganized manner. It is not organized. For example, if I am an insurance advisor or a mutual fund advisor, that will be taxable because it has the correct line of everything. From a company, it is coming. They will be applying in my PAN card, so it will be reflected automatically in my Form 16 or any of the tax kind of thing. But as an individual, I'm getting from another individual. I don't have the correct source of income to be shown. But however, you have explained that I can source as other business or other income in that category. But as of now, when I am filing with my auditor, I couldn't able to give all those details.
No,
but my bank account is being synced with the IT when I am doing it, because I'm giving all the savings bank account.
Okay.
So will there be any extra tax implication?
Yes, that will see basically what happens if there is any tax. See, now currently whatever income, the tax point in India is our self-declaration. The government only tests around 1% of the total returns. I am voluntarily declaring my taxes or my incomes. Now, this incomes which you have been that are coming to you, you have to declare voluntarily and add it to your income. They won't reflect in TD under your traces or 26As, because there is no TDS done on it. But then voluntarily you have to declare those incomes and put them under the income of business or professional charges or consultancy charges, and pay tax accordingly to that. If it is not done, if there is any query or some bad luck, your return comes under scrutiny, then your bank passbooks are called, and then this all transactions will come up openly, because you are taking money on your bank transactions, in your individual bank transactions. So automatically it is proved that the money has been paid to you. So you'll have to put the source of it. So what you can do, I don't know your family structure. The best option is, if your spouse is housewife, you basically take this income in her account and do her individual business returns. So that is not added to your salary account. If you cannot do that, and if it is added to your account, month on month, try to maintain certain records of that, where the money has come on, which sheet in a simple Excel sheet, and you can hand it over to your tax consultant at the end of the financial year. So it's easy for him also to recollect all those things.
But that can be done only if it is a joint account, correct? If it is my individual account, that I cannot show it in my wife as income.
No. No, my suggestion is, you don't take in your individual account, or even in your joint account. You take, see, basically when the person is going to pay you as a consultant, you can ask him to pay under certain account. Na? It need not be your account. Na? You can ask him to
be a joint account.
My wife's account. So the money can go there, and you can create a consultancy for her there.
Okay.
I have
more question.
Pardon?
One small question, I'll go ahead.
Yeah.
Only thing is, you told about expenses on that income, no, sir? For example, I'm doing some consultancy. I'm incurring some cost in it. How can I show the expenses? Can I
you can
randomly or any?
No, you maintain a proper account month on month, what income is coming in your Excel sheet on one side and the expenses that you're done on other side. Whatever professional expenses, your mobiles, your traveling, your outings on other side, and give this total final bill to your tax consultant at the end of the year. So he can do all those expenses adjustments, and finally the balance amount only will be added to your incomes then.
Okay,
You
sir.
can maintain a proper books of account for that, separate books of account. In your Excel, a simple Excel is okay for it. See, you can just put entry on left side, what are the incomes coming in person wise, and on the other side, what are the expenses you have done in that month. That's fine.
Okay, sir. Do you file income tax on customers also, sir, so that I can contact you?
Yeah, we do help in tax filings. Basically, I'll tell you at the end of the session, we do help in tax filing. Sure, you can call up your advisor. Sure. Okay, one
I
more
have
question.
similar question
Yeah.
regarding this.
Yeah.
If like I am a trader, I should do trading. So in that case, if in financial year I am in a loss, so how should I declare that, or
See,
should I not declare it?
See, the investment income from equity, specifically trading, is has to be set off against equity only. Other losses through equity only. So you can carry forward the losses for next 5 years in the equity in equity, almost 5 or 7 years almost. You can carry forward the losses from equity to equity. So again, for this, you for when you are doing your tradings, you get a proper list of accounting on your activities done for the financial year. That has to be submitted to your CA, the capital gain statement for the current financial year, and it can be carried forward in the returns when you're filing it properly. In fact, that is mandatory. Any capital account, if you're not showing in your equities, it will be creating trouble because it's all recorded under your PAN. So you will have to compulsorily show your trading accounts there.
Okay, thank you.
One more from Mr. Rahul Jagtap. I am planning to buy next 15-year home. Which option is better for me to invest in PPF, mutual fund, or LIC? Okay. Rahul sir, see, basically housing loan and investments are two different sectors. Housing loan by default, when you go for an EMI, it will be a tenure of at least 15 years minimum, and you plan a strategy and create a outgo liability control plan and see that it can be squared off within 10 to 12 years. Investments is a total different sector, may it be mutual fund, LIC, or PPF. That is basically for some other personal goals that you have, maybe your child education or your retirement planning, whatever. So my advice here will be, sit down with your advisor. We also need to understand what is the EMI liability, what will be its effect on your take homes, and how much financial cash will be crunched there under your take homes. Then can we have unparked cash for investments or not? Based on that total activity of outgo management, then only you can decide what investments and what type of investments you can go for. Let us try to understand outgo management. A proper outgo management is the first base of your wealth creation, is the first step of your wealth creation. And in outgo management, it basically starts with tax planning. So if you do a proper tax planning with a horizon of next 4 or 5 years, what exactly is going to change in your family requirements, then you move into step 2 of your outgo management, where you work out on your cash in hands, unparked cash. Once you know, okay, this is my unparked cash, then you sit down and work on your goals. Okay, what are my short-term, mid-term, and long-term goals? Do I need it for my retirement? Do I want it for my child education, a second income, or I want to create a housing capital 3-4 years down the line? Once this duration is decided for your capital requirement, then only the product comes into picture. Because if I'm looking for a 3 years investment, I want to create a housing principal in 3 years, you will have to be compulsorily in bank FDs or RDs. You cannot go to mutual fund, LIC, PPF, not allowed, because it cannot give you liquidities. If you have a horizon of 15 years, a child education, then I am there or not there, I have to make that provision available. Then insurance plays a very vital role there. Then the inflation will be also there, which will affect my investments. So capital market investment will play a very vital role. So a combination of a proper insurance with a proper capital market investment, may it be mutual fund or equities, can play a proper role. So person to person, depending on his goal requirements, on his risk-taking capacities, his decision of investments will change. This is what we say at Dream Invest. This is your homework, and this is your individual role. You need to sit down with your advisor, work on this role, understand your requirements, your priorities, your limitations, your habits, and then only go and purchase something from the external market. External market is available 24 hours for us. It will be available. It will be there when we are there, we are not there. It is going to affect our investments directly, indirectly, positive, negative. But in the same scenario, A person will make wealth and B person will not make wealth. That will be basically what the decision has been taken by that A and B. So fundamentally, sit down with your financial planners, with your advisor, and they are expert in this. May it be Sachin, Sagar, Mahendra, Abhishek, they all are, the Sawan sir, they all are expert in this, and they know how this to be done. And they will very positively help you in this. Further, if you need any help from my side, by default, we can meet in person and we can have a discussion on that. There is one question. Can we take advantage of the home loan, stamp duty, registration charges while in tax exemption? Yes, you can take stamp duty and registration charges in your current year tax return, subject to you have got the possession of the property. So if you have got the possession of the property, your registration charges, stamp duties can be taken under 80C. It cannot be taken under 24(2) as interest. It can be taken under 80C as exemption, subject to you have the possession letter of the property. Okay, these things, I think these are the final questions that are there. If anyone has to ask further, we'll just wait for 1 minute. Okay. I am having a housing loan for which I am paying a monthly EMI and claiming deduction. I want to make investment. Okay. I want to make investment for children's education. Can I repay the loan entirely in 2 to 3 years? Next, and more money can be. No, sir. Basically, your personal goals and your EMIs are parallel. They are two banks of a river. You cannot move on one bank and then come to another bank, because as you just think of repaying, let us say, let me assume your child is age 2 now. So 16 years down the line, it is your wealth creation that is needed on his age 18. Let us say you are taking next 2-3 years to repay your housing loan and then come to his education planning. By that time, you have lost 3 years on investment. A 3-year loss on investment is almost 30 to 40% loss on compounding effect, because you are losing the last 3 years of the investment, not the first 3 years. The compounding, for example, he is 2 now, so I'm investing for 16 years. Now, if I wait till he is age 5, I'll be investing only for 13 years. So I lose those 14, 15, and 16 years of investment. So compounding effect will be a major effect on your investments. Second thought, again, if you are in the position of repaying your housing loans, that means your interest components have dropped down drastically. So when you repay your housing loan totally, you're not getting that tax benefit from your under 24(2). So again, you will be increasing your tax liability there. So my suggestion is you balance this to your outgo as well as your child education. Again, my suggestion will be, this is my upfront answer, but my suggestion will be sit down with your planner and discuss exactly the scenario, because person to person, case to case, this will vary. Person to person, case to case, this will vary.
So there's one more question, Ria Gaikwad. So she's asking, can old to new regime possible in the next year? So I'll answer that. Yeah, you can go ahead.
Yeah, no, it's not possible. Yes.
Old to new is possible.
Okay, sorry. Old to new regime, you are allowed to shift anytime. See, the fundamental thing is, if you just try to read this, we are shifting from a indirect tax code to a direct tax code. The DTC, what we had roughly, this was brought by Manmohan Singh 15 years back, direct tax code, but it wasn't implemented. Now this is where this government has taken a generational change. So it's just giving us a shift over time period to move from old tax regime to new tax regime. So anytime in your due course, current year, next year, after that, you can shift from old to new. The reverse shifting won't be allowed from new to old. Fine. Okay, let me just summarize this as we end our discussion. It was a very thought-provoking activity. Thank you, Mahendra, Sachin, Sagar sir, Sawan sir, and Abhishek for organizing this well. Let me just summarize. Point number 1, you need to sit down individually and work on your requirements for next 4 to 5 years, and then only decide what tax regime you need to select. Currently in your declaration, if you need to give declarations currently, my suggestion is sit down on, give the declaration for old tax regime only. Because at the time of return filing in the next financial year, we can take a call if I want to move to new or not. So currently stick to the old regime in the declaration, and in the due course of the financial year, as you sit with your advisors, you can take a final call. Third part, tax planning is only one part of the portfolio. The most important part of your portfolio is your investment planning process that needs to be put into place. In the investment planning process, you are more important than any company, product, or any economy as such. So understand your rules, play them correctly, and take the support of your advisor to help you to create that, to know that rules, and reduce your total anxiety in the total investment process. So wishing you all the best, and be safe, take care. Thank you very much. All people who are on YouTube, my request is do like and share our channel, and subscribe to it, because in due course we'll be putting up regular educational activities there, related to individual personal finances. There will be multiple videos uploaded there, starting from your outgo management up to wealth creation, wills, and everything we'll be putting up there in due course. So please like and subscribe to our channel.
So also like to thank you, Sunil sir, for your guidance and for sharing the information to our clients. Thanks for that.